All right, thank you everyone for joining us and welcome. Truth is rarely pure and never very simple. As Oscar Wilde said, in the next 45 minutes, we're going to sort of grapple with that concept, hopefully giving you a few aha moments as to what we perceive as truth, as well as asking you all to help us really correct some misperceptions about crypto and stablecoins. It really feels as though we're at a pivotal moment, and it's now more than ever very important for the leaders to help with the narrative, and you'll hear what we all think is the right narrative to help us grow even further. But I'll kick us off sort of what I think is the most compelling for the momentum, which is essentially my panel up here and all of you in the audience. What an amazing development to have Stablecon. Thank you to all the sponsors, and to have such a vast group where we've got one of the largest stablecoins with Spencer. We also have sort of two OGs of innovators with Luca and Christian, and as well as Catherine, one of the biggest global payment giants. And when I think of a misperception, actually before I do that, I just want a reminder that we'll probably veer into personal opinions, which may or may not represent the organizations that we're affiliated with, so please keep that in mind. I'm going to turn it over to Christian in a minute to help us sort of with some top misperceptions. From my perspective, I really hope that we can correct the narrative that stablecoins are not secure unless we layer on sort of a Web 2 paradigm for anti-money laundering and know your customer controls. Not only from my perspective is that dangerous for personal financial privacy, but it's also detrimental to the growth and sort of the promise and the optimism that I think you're going to hear all day today at Stablecon. And by way of example, when you look at some of the reporting out of France because of MiCA, arguably, at least in part, and the requirements for disclosure of personal information, such as physical address, has led to some violent crimes against entrepreneurs. And of course, you're going to hear a little bit about what we hope is the upside. So why don't I turn it over to you, Christian, for what you think is compelling for momentum, as well as your top misconceptions.
Thank you, Beth. Morning, everyone. I'll start with at least 3 items that I think are pretty common misconceptions about stablecoins. The first one, and this is not investment advice, is that being a pure play stablecoin issuer, it's going to be extremely hard. And when we look back, I think it's easy to get confused. Being an issuer to date has been a very profitable business. But this was a time where the key job of an issuer was to not steal funds and to retain the peg. That's a very low bar if you're trying to build the next global financial system. As regulation comes in, I think we'll see a much more level playing field, a lot more fragmentation, and many more issuers come to life. That also means that issuers will have to come with their own distribution. That has been important in the past, as we've seen in some of the key partnerships in this space. But going forward, if you have access to merchants or consumers or fintechs and businesses, that's what's going to drive volume, and more importantly, not so much market cap, which again, it's a metric of the past, but TPV, total payments volume. As we see that change, regulation would also make it so that all of these stablecoins will be good money. That's the goal of good regulation. And the moment they're good money, they will do a transition that's very similar to what we've seen with electricity. Actually, we're not too far from Pearl Street's electricity cogeneration station that Edison, back in the day, installed to serve New York. At the time, electricity was kind of a luxury good. People had, Edison bulbs in their home. It was differentiated. But then Westinghouse came in. It was all about the distribution, about lower cost. and the electrons all look the same. I think that's what's going to happen to stablecoins, and there's many players, including incumbents, that have an interest in seeing a lot more competition at the issuer level. So that's, I think, the first misconception. The second one is that today, the dollar dominates the stablecoin ecosystem. It's like 99%. 5 years from now, I think it's going to reflect a lot more like global trade or FX markets, so anywhere between 80 to 60%. And of course, geopolitics may play a role in this too, so the percentage may be even lower. Domestic stablecoins don't look very attractive today. They have lower volume, lower liquidity, but as we've experienced even in the Libra days, regulators will want tighter controls in these jurisdictions, and dollarization is not going to be a very palatable service in many of these countries. So as that evolves, I would expect domestic stablecoins to play a bigger role. They're also very important for creating new markets. Who wants to borrow in dollars if your currency is highly volatile? You want to borrow in your own currency. So I think that balance of power between dollar-denominated stablecoins and domestic is meant to change, and regulators will play a big hand in driving that transformation. The third and last item is that although I think often we think of the stablecoin sandwich as the killer app of crypto today, I don't think we have a killer app yet. And I think it's both good news and bad news. In the end of the day, the stablecoin sandwich is more a reflection of being able to glue together domestic payment systems. Think about UPI in India, Spain, Mexico, Pix in Brazil, and alike, maybe eventually FedNow in the US, through open and interoperable rails. But the asset doesn't really matter. At scale, people will use all sorts of different tokenized assets, whether it's tokenized treasuries, tokenized money market funds, narrow bank-like stablecoins, deposit tokens, even Bitcoin, which is highly liquid and sought after in many of these markets and can be set up as a pay-for-order flow arrangement in many of these transactions. So as that transformation happens, I think we'll realize that stablecoins, and in particular programmability, are still looking for the killer app. Now, many of you will say, well, agentic payments, that's where programmability really matters. But the reality is that if you look at the landscape, every single incumbent, and we have Visa here at the table, but also PayPal and Stripe and many others, have their own agentic SDK. They've embraced MCP. And so decentralization may well be the end outcome, but it's far from guaranteed. So yeah, those are three opening ones, and I'm sure we'll uncover a lot more together.
Yeah, thank you so much. Luca, what would you add?
Difficult. I will try to spice it up a little bit to make it, but I'm not going to add much more. But I think that, so in my opinion, one of the first misconception is that stablecoins, money is not a product, money is infrastructure. That's what it is. And I think you look at a balance somewhere, and there is like a very complicated system of checks and balances behind it that gives you some sort of guarantee that your value is there if you need it. Same for stablecoins. Stablecoins are not, I hate also the term stablecoins for many reasons, but I'll skip it. I fought that fight, I lost it to change the name, but it's all about how you actually recreate the checks and balances that currently exist in the traditional banking system, dual banking system, on new rails. I think, in my opinion, I just want to double down on what Christian said. One of the reasons, I think, in my opinion, 1/3 of the people are here because they look at how much money Tether is doing and say, okay, well, I want to make as much money as Tether. Unfortunately, it's not going to work like that. The second third is here because Zach sold Bridge to Stripe for $1.1 billion, and they want to do the same. A bit more doable, but tough as well. And the third probably is interesting what's going on in stables and is curious and probably is an operator. The reason why Tether is because at the time, Tether was the only access to a massive distribution network that was crypto. This is changing. So the over-indexing on issuance, in my opinion, is the wrong strategy. The money is going to accrue at the distribution layer, so that, in my opinion, most of the fun is going to be in the middle, creating very cool infrastructure to actually connect the issuance with those that create very cool stuff on digital money. So anyone who is actually thinking from traditional finance to issue a stablecoin or to get into the stablecoin game, unless they are able to build Hyperliquid or Uniswap or Noble, they're not going to be relevant, or they speak their language. And I think this new generation of builders is very, very different from the old one. And then the other thing I wanted to say that I forgot, no, I mean, apart from the jokes, is that it is inevitable. So we are seeing a transition into narrow banking and digitalization of money with the Genius Act. This trend will not stop. Will absorb progressively credit creation, will absorb different types of intermediation, and so the base layer that is enough to be very competitive and compelling, which is creating like risk-free proxies on chain that can be used, is not going to be enough very, very soon and needs to be augmented. So my CTA, my call to action here is that unless companies are ready to understand and get involved with builders that are building new things and they're speaking their language on top of digital banking rails, actually getting involved in the stablecoin game is just lost time. So I think that's is more like an incentive for people to really get involved and understand what is really being built on top of those new instruments.
Yeah, thank you. And Catherine, kind of building on that, I think basically what both Christian and Lucas said, when you look at the killer app potential, and that it's inevitable that the momentum will continue as long as we're focused on building really good use cases. When you think of sort of that North Star, what do you think the blockers are? Some misconception we haven't talked about? Is it just inevitable and you think we're going to get there and it's a matter of timing, or something else that we haven't covered yet?
Yeah, for sure. Firstly, I want to say that the Visa Crypto team has been sort of exploring and building the space for the past 6-7 years. So definitely, we have done a lot of trials and errors ourselves and trying to really find out where the path is taking. I do think that as of today, I think everyone feels it. This year is very different from everything else we have experienced because of the regulatory clarity, especially in the United States, but also we're seeing that in Europe and stuff happening as well. So I do think that will help to drive it. Having said that, I don't think stablecoin has reached that sort of critical point yet to say we're already on a sort of equilibrium or on a sort of exponential growth. I think we're getting there. If we're looking at the data, right, like today, I think the total market cap of stablecoins is around $220 billion, and we have our Visa on-chain analytics platform and tracking sort of the payments volume over time. So it's around 6.5 trillion over the last 12 months adjusted basis. Now, if you put that number in perspective to the relative, like how much trading and payments volume activity is happening on a daily level in the traditional rails, that's like peanuts compared to everything else we're talking about. So certainly I think it's very positive, like we are having the momentum, but I think echoing what Luca and Christian has said, I think we do need to focus on the application layer and to think about the real use cases of what are people actually going to use it, because I don't think organically that's just going to happen, because you need everything else, the infrastructure, to really help you to get there. And from our perspective, firstly, thinking about stablecoin, the acceptance of stablecoins is very important, because there's a lot of friction point in terms of how you can use a stablecoin to pay a merchant at the end, and frankly today it's very hard to do. So we've been launching things like stablecoin linked cards for you to be able to spend your stablecoin straight away from your digital wallet. I think the other areas that we're really interested, for example, is looking at stablecoins in a lot of the cross-border money movement flows. So whether that's P2P remittance, B2C payouts, or B2B payment flows, there's a lot of opportunities in which stablecoin can be used. And I actually think one of the misconceptions, at least at the very original stage, is always thinking about stablecoin as a front-end sort of user product. It doesn't have to be that way, right? Because as we're just talking about the stablecoin sandwich, stablecoin can be perfectly used as a back-end infrastructure. As a user, I'm just trying to send money fiat to my friend in Brazil, in the UK. I just want to get there faster than, say, 2 days. So how do I do that? Maybe as the application, you can provide the stablecoin on the back end, and we're already seeing that happening across some of the fintech worlds. And to me, I think that's the real innovation. You're really trying to solve the pain points, which is the speed, the efficiency, the cost, and that's where we should be focused on.
Thank you. And Spencer, when you think about the pain points and the misconceptions that we've been talking about, I want to make sure if you have something to add on, please please hop in. But also, I wonder if you want to sort of help us sort through, is it helpful or not if we're very quick to label different product innovations as stablecoins, whether it's in the DeFi realm or the yield-bearing realm versus what might be considered a stablecoin under MiCA or some of the early drafts of the US legislation. As an industry, are we just too early to label things as stablecoins? Does that hinder, you think, this trajectory that we're optimistically talking about?
First, let me just say thank you to the Stablecon team. Nick, this is an incredible inaugural event. Beth, to you for having me on stage here. I'm not a big labels person. I think the notion of a stablecoin is meant to give, I think, whether it be a retail user or an institution, certainty on what they have, right? Like, this is a product, it's an instrument that will not fluctuate, right? We Circle, feel quite strongly that the US nexus that exists around USDC is a feature, right? It is the reason why I believe institutions like Visa and other large enterprises will adopt at scale. So I think the labels are almost somewhat trivial or irrelevant. I will say, we recognize and know there is the notion of assets at rest and assets at motion. Assets at rest, there is an expectation within traditional financial services and in crypto capital markets that those assets are going to be yield generating. We understand and recognize that. Circle has made a significant investment in acquiring Hashnote and their USYC product. We think that the interplay between USDC and USYC represents that duality of assets in rest and assets in motion that are going to power the internet financial system. And it's because the depth of liquidity of USDC, if you have an asset at rest that might be earning yield or potentially
Yeah, that's interesting.
an asset that's backing collateral, right, in a trading context, those two things need to be interoperable with the depth of liquidity of USDC. So from a labeling perspective, I may be slightly, didn't answer your question, but that's kind of how we think about it.
Yeah, and I'll open this up to everyone, but maybe following on what Christian threw out there a little while ago, are we too US-centric or optimistic that the US dollar is going to be the predominant peg for stablecoins going forward?
So I'm not an economist, I'm certainly not an historian, but look at, the 19th century, right? UK's pound sterling was dominant, and it wasn't until the middle of the 20th century where the dollar took over and has been enjoying, that position as the sort of base layer for the world economy. What I will say is, these things don't happen quickly. It's not impossible for the dollar to lose that rank globally, but these are tectonic shifts. They do not happen overnight. So that's kind of how I think about it.
I think the reality is that we live in a much more multipolar world, and I think across all of fintech, you're seeing really two blocks between East and West emerging, whether it's traditional rails like Swift, or more crypto-based ones like Binance and Coinbase. Like, that split is going to drive different choices. Some countries will embrace CBDCs, and that's going to be kind of their platform of choice. They're going to try to internationalize their reach, whether it's through mobile payment apps that we're seeing popping up all across different continents, and that reach is going to be important from a geopolitical standpoint. The dollar, yes, the dollar has been serving that purpose for almost 100 years, and if you look historically, that's about the max for every currency. I think there's really good reasons for why the US can reinforce that dominance and perpetrate it into the future, and I'm really hopeful that we will. That said, I think the dollar is under stress, both from other countries that would like a different standards and from new digital assets like Bitcoin. So I think that's a really interesting interplay. And I think when it comes to global settlement, not only we should expect a lot more fragmentation, like Luca was saying, across different types of dollar-denominated assets, yield-bearing and not, but also between CBDCs and digital assets like Bitcoin and everything else. And if I'm issuer of coin A, do I really want to terminate on coin B if coin B is my competitor? What's going to be kind of the lingua franca between those two assets? And I think in the digital asset space, there's only one asset that has the depth and liquidity to serve that purpose, and it's Bitcoin.
It sounds like it's not just fragmentation, but also just different choices based on demand.
Yeah, I mean, I just wanted one more thing that is important to us. Like, we at M0, we sponsor coffees today for a couple of reasons. First of all, because we know that listening to us talking about stablecoins can get very boring, so people can stay awake. But also because we wanted to point the finger to the fact that, and you can read it on the coffee cups, that financial services are embedded everywhere. And the use cases are infinite. We were used to the fact that there was a very sleek front-end financial applications on your phone. Behind the scenes, there was a pretty antiquated financial institutions that was doing the checks and balances. And to Catherine's point before, I personally think that what we call stablecoins is actually rewiring this back-end financial infrastructure that is actually powering, in a good way, financial applications. Cross-border payments is lowest hanging fruit, right? But it's everything. Is deposits, is whatever type of storage of money. And I mean, I can talk for 1 hour about what people are building on it, what we're creating as an infrastructure at M0. But so I think this connects to the point that there will be any type of application, and as the more we onboard on those Rails new applications, there will be significant other currencies that need to be onboarded, right? So I think that people always say the southern part of the world loves the dollar. Kind of. I spend a significant amount of my time in Brazil. Brazil is one of the largest economies in the world. The inflation is very high. Brazilians don't care about dollars. They think in reais, they spend reais, they use reais. If you don't have digital real, they will never onboard stablecoins. It's going to be 1% of the market. But so it is going to get multipolar. At the same time, the euro-dollar market, the offshore dollar market, is probably, 50 times the current dollar stablecoin float. So there is enough to build. And definitely, is the dollar going to be forever the reserve currencies of the world? Definitely not. By definition, nothing lasts forever. But is it in the interest of the US Treasury and the government to try to perpetuate this dominance as much as possible? Absolutely. And this is one of the best ways to try to do it. So it wasn't surprising. I mean, somehow it was, but it wasn't also surprising that there was one side of the political debate in the US that was really trying to push this, the support of this instrument, if well designed, of course, because then sometimes stablecoin is a term that hides a lot of different types of risks behind, not always at the benefit of the consumer.
I'm just going to add one last thing, and actually building on what Spencer, you were saying, because I think what's really interesting right now is to think about stablecoin as this new store of value notion that previously I don't think it's been very well articulated. And this is kind of combining the historical sense of things in the fact that at the very, very beginning when we had cash, right, and nothing else, cash is used both as the medium of exchange as well as the store of value. That's the classical definition of what money is all about. But of course, in today's world, we have banks that does all the savings, the deposits and stuff. And then separately, we have the payments and the payment rails to conduct those things. Now, if you look at stablecoin, that's a combination of both again, because that really is that representation of digital version of cash. And we've seen what Stripe has done, right? The stablecoin financial accounts, because I think it has a lot of appeal to a lot of the countries in the emerging economies where now they can have sort of, I call it a quasi sort of a dollar account that maybe is very costly for their local banks and others to serve directly. But all of a sudden, as a small business, you can have access to dollar. You can directly pay out or get paid in dollars. That becomes a really novel innovation in and of itself. So I do think that this is where this is probably what we haven't thought about much at the beginning. But given in many other countries you have inflation concerns, you have concerns to access to dollar itself. Having that stable coin represents a sort of a new way to hold and store your value in that sense. So.
Thank you. So let's shift gears a little bit and maybe sort of be a little bit of the contrarian about all this optimism about stablecoins and talk a little bit about the hype and whether there's, like what your perspective, maybe I'll start with you, Luca, on those critics that say stablecoins are boring, they're really just Wall Street 2.0, and we can see that with some of the banks coming in to the fray. Do you think that the skeptics about the ethos to the true upside potential for blockchain, or is it a misconception that stablecoins aren't that pivotal, or is there some truth there and some threats that we end up just improving on the financial system that's already there just using the blockchain?
Difficult question. I think that I think I'll take this like a different spin. I think we grew up with this idea that great stories are 2 hours long, like in the movies. 90% of the reason of success of great stories and great revolution is boring. It's a lot of work. So are stablecoins boring? I hope so, because it means that now we're really doing serious stuff. And I understand that some of the crypto native people, they consider this boring because most of the early day crypto builders, they lived in this phenomenal moment in history where there was no limit for creativity and they were recreating anything, and there was a lot of huge payoff to create new primitives that were not even useful. So now we're actually in this state where we are helping maturing an infrastructure, and this is a lot of boring, repetitive, high quality work. So I really hope stablecoins get boring, and they will get more and more boring as they grow. Now, on blockchain versus not blockchain, I think that what also blockchain doesn't mean anything. It's like also how you define it. What is important, and I think this is a clash between traditional finance and crypto native builders about how open you're making those systems. And even if you look at Stripe now is moving on the stablecoin side, but most of the instruments they're creating are a hybrid, are not entirely open source. And I think that what we should take from this, from the last 5 years, I believe, is the power of open architecture. And whether it's on blockchain or whatever it is, I think the power of composability and open architecture is something we absolutely should preserve. And we will see more and more financial institutions try to challenge this assumption in good and bad faith. Sometimes in good faith because it's easier to control closed gardens, but it's also easier to make money in closed gardens. And so I think that it's going to be, but in my opinion, they will lose. They already lost a few times. But this is, I think this is going to be like the main battle, like the battlefield, like how open source and how closed source we're making certain things. And even the decentralized financial sector, like the DeFi sector that exists today, evolved a lot since the last 3-4 years and became way more compliance friendly, institutional friendly. Institutional, in my opinion, means very high quality and able to vehiculate a lot of money. It doesn't mean with a license or a compliance mode necessarily per se.
I want to double down on that. I mean, if you look back in history, there's 3 moments. 138 BC, the Silk Road, the first permissionless network for the exchange of goods and services. Then we have the web in the 90s, the free exchange of information. And then we have the Bitcoin white paper, right? So that's the third one. And as boring as it sounds, it's always about the infrastructure. What really is going to reshape markets here is the fact that we can build on open and permissionless networks. That's the innovation. Even the stablecoin sandwich is a direct result of that. The assets honestly don't matter. Now, does this mean that we're going to land in a world that's fully decentralized? Unlikely, right? If you look at all of those historical innovations and how they evolved, eventually there's new vectors of concentration. The internet has led to some of the most successful global companies of the world today. I think we're going to see the same here in fintech and in crypto. It's an opportunity both for new entrants, like many of the people in this room, to come and compete on a much more modular stack. Pieces that were bundled together. If you think about card networks, credit, chargebacks, fraud detection. These are all modules that, yes, AI agents will eventually rip apart and recombine. So I think it's a new operating system for financial services and payments, and people will build in a very different way. But again, the decentralized outcome is far from guaranteed. And I think if you're watching the moves of many of the incumbents, they understand the technology, they're going to play a role in it, and they have a lot of assets to bring into the picture, including distribution.
Anything to add, Spencer? I mean, we're talking about sort of, I guess, a raging truth that it's okay, it's not a misperception, but do you also sort of foresee some of the innovations that are really going to be less boring, so to speak?
My view and the company's view, the space we occupy has maybe a little bit of the glamour and buzz associated with being on the cutting edge of technology. The reality is, we're in the money business. And the money business intentionally should be, or is, boring. Maybe with the exception of people that are on the stage, where we're somewhat nerdy, we love the technology, we love the innovation. To Christian's point, the programmability and composability is the real revolution. Yes, speed, being able to eke more yield out of a transaction because of the capital efficiency. These are amazing benefits, don't get me wrong. The global nature of these interoperable networks. I think about, it was made mention earlier, FedNow here in the US, UPI in India, PIX in Brazil. These are all incredible innovations that stand on their own, right? Like, I look at what the Brazilian government was able to do with PIX in 3 years. It's phenomenal. There has not been an innovation like that in any major economy in my lifetime, I would say. But the reality is, these are separate standalone networks. They are not interoperable, right? And so the innovation is in the programmability. The innovation is in the fact that this is a new money layer on the internet that did not exist. It simply did not exist before.
I'm going to add two things. So firstly, I'm actually super excited about the whole growth of real-world assets right now. And I do think this is the major sort of innovation coming from programmability perspective is going to happen, because as we're thinking about, I'm sure there's lots of reports and white papers written about projecting this is a multi-trillion-dollar business, bringing everything on chain. If you look at the size of the market capitalization of stablecoin today, which is the liquidity side of things, it's only hundreds of billions, right? So there clearly is a mismatch in terms of the potential value of how much total tokenizable assets that could possibly be versus how much of available liquidity you have. And that tells you there is potential growth to be tapped, which I think is super important, because as we're starting to look at these new innovations, the programmability aspect, I don't think is even fully leveraged at this point, because right now we're all focused on how to improve efficiencies of existing system, of existing infrastructure, make it faster and cheaper. But the bigger potential is open up whole new business areas that's never been possible unless you have these composability of things. And I think that's what's really interesting is you separate out the stablecoin from the blockchain, right? Because blockchain is that core infrastructure technology upgrade that we finally have encountered. And for the first time, blockchain represents this general purpose infrastructure that you can do trading, capital investment, payments, lending, everything combined on a single piece of technology. Because today, everything's fragmented, right? The stock market is on its own, the bonds market and payments is all fragmented. So now finally you have this general purpose technology, which I think is very powerful in terms of aggregating a lot of these things together. And that, in my opinion, is one of the really exciting things as we're looking at, say, on-chain lending, on-chain finance, lots of things to explore. And then secondly, I do think with respect to just the payments area, let's not ignore that many other innovations happening as well alongside blockchain. And I do think, if you already have a very fully developed real-time payment system, that's great, because if the majority of the use cases is purely focused on the domestic use case, then frankly, I would challenge what's the use case of having stablecoin on top of that, because again, if the pain point is solved, you don't need that. But I do think what's interesting about stablecoin is, think about stablecoin and the blockchain as that global real payment rail, right? Real-time payment rail that can connect into all these localized RTP systems. And then you can start thinking about cross-border money movement. And again, it's becoming really interesting as we're thinking about the 24/7 always-on infrastructure.
Yeah, so when we think about, we've spent a lot of time talking about global payments or payments infrastructure. is it a misconception to say there aren't other use cases such as treasury management for DAOs? I mean, maybe it all comes back to payment, or even foreign currency, the way in which we do that trading, or other use cases beyond payments?
I mean, I think that everything. I mean, the point is, today, if you want to launch a new bank or a credit card provider, or if you want to actually have digital wallets on your application, if you're an exchange, or if you're like a gaming business, whatever, you can do it on crypto rails in, I don't know, on M0 network, you can do it in 2 weeks. You don't have to sign anything. Probably like 5 years ago, you needed two years. So there is a huge new cohort of builders that are building whatever use case on those rails super fast, and the barriers of entry are getting lower. So fintech and tech are merging, have been merging for a while, and the entirety of fintech is going to be built, in my opinion, on those rails. So I think that we should obviously talk to incumbents, and the smart incumbents are understanding that in order to perpetuate the incumbency, they need to innovate. But the truth is that the next Visa, the next Robinhood, the next Revolut is being built now by teams of like 20, 50 people that are building on those rails. We don't know them. Hyperliquid started to dominate the perp exchange market in 18 months. They were not existing like 2 years ago. So there is a new cohort of juggernauts in generational companies in financial services that are being built now on new rails. It's not only DAOs or like small niche use cases. This is most probably, if we are right, is going to be the financial layer of the future. So I would really urge everyone to talk to the teams that are now building, and they're very small but very smart, and they're going to change what we're going to see, the way we're going to experience money in the next 20 years.
I think one of the superpowers here is really the combination of regulated financial activities as well as non-custodial features. So we're just scratching the surface of that. Non-custodial has been always on the fringe to date, but if you're trying to go global as a fintech, there's no better tool than building on something that gives you the ability to onboard 1 billion users right away, and then integrate on and off ramps, maybe through partners, maybe through an open network like the one we're building with UMA and Spark, across the landscape. So to your point, I think the modular nature of this will allow people to rebuild what we have today in very different forms. And that's the part where incumbents probably have to be the most careful.
And can I jump on this?
Sure.
So fully aligned, this is maybe the most aligned panel I've ever been on, which is incredible. I've spent the better part of the last 15 years of my career in payments, and I'm incredibly excited about what payment innovation still exists, whether it be treasury management, on-chain FX, which I think is a massive potential area of growth. We're also really excited about what we're seeing in emerging markets. And this is somewhat obvious, but I think worth noting. When the real lost value last quarter, Nubank, who's a partner of Circle's, Nubank, who's effectively the largest fintech in the Southern Hemisphere, 110 million monthly active users. You saw the USDC volumes. Every Nubank user has access to a dollar bank account. When their fiat currency was devaluing, they're getting access to dollars. I mean, that is incredible. Most of these economies and countries and central banks, they don't allow access to digital dollar bank accounts, right? So the fact that these users, these consumers want access to our currency is incredible. We should feel proud, that position we hold. But the fact that that is now available is a massive innovation that just simply didn't exist.
I think the challenge with that will be that at scale, the Brazilian regulators won't be happy with it, right? So that's I think where the domestic stablecoins
They put a 5% tax last week on dollar off-ramp.
Right. We've experienced it with Libra.
Okay, so I'm gonna wrap us up with ask you all to give sort of one truth, either for the audience to take away or what you hypothetically might post and you want people to take away a truth about stablecoins. And I'll start us off by saying, regardless of what we might think about the regulatory environment, I think the truth is as Luca said, we want leadership We want the innovators who are going to innovate responsibly, whatever might be going on in a different region. And that means sort of building trust in those that are issuing or being part of the stablecoin ecosystem, avoiding conflicts, and some of the basics that Christian covered with, no theft, no fraud.
Okay, I'll go first. I think, look, there's massive potential in self-driving, programmable dollars and other digital tokenized assets on chain. I would say we're still very early, and I think there's a lot more work, like Luca was hinting at, on those on and off ramps, on those regulated features of this, to really unlock the full potential of the technology. It's also important to keep in mind that I think we have another big technology on the horizon, which is AI. And I think that's going to decide essentially where this goes. Is it going to be a much more decentralized ecosystem or a more centralized one? And that's where I think a lot of the financial incumbents have a number of cards to play. And the startups that are in this room will have to be clever about what kind of shovels are you going after in this gold rush. And issuance is unlikely to be a shovel. It's more likely to be like the gold certificate that people were trying to get in the gold rush back in the day.
Yeah, I mean, my last words on this is that, first of all, I think this is the biggest biggest revolution in financial paradigm we will experience in our lifetimes. So it's worth spending the time. It's huge. The other one, though, is what Christian was alluding to at the very beginning is, while issuance and custody and protection of assets is very important, it's going to get commoditized very quickly. So we need to learn to speak the language of builders that are building stuff on top and making their lives simple. This, in my opinion, needs to be our obsession. And these people are code first, tech first, quick, minimum paper, and they want to they want to program as much as possible. They want modular infrastructure, efficiency. They don't like cost, and they will accrue most of the money. So I think anyone who is in this space, they shouldn't over-index on something that is going to get commoditized very quickly, and they should spend a lot of time learning the language of those that are building cool stuff on top.
And Gen Z, yeah, Catherine.
I guess I would start by saying I do very much wish and hope that the next Visa will still be Visa, because we're here to actively really try to embrace stablecoin. There's a ton of opportunities here, whether that's, as I said, beginning, acceptance, stablecoin linked cards, whether it's on treasury and settlement, on money movement, on the tokenization of the money itself, around programmability, on-chain finance, etc. It's just so many different opportunities that I think is out there for everyone in this ecosystem to play, and we're actively involved in this. I would just say that, whether you're a bank, you're an asset manager, you're like a financial, FI of any sort, I think everyone needs a stablecoin strategy in 2025. That's kind of imperative to me, I think. And, we would love to work with any partners out there to really drive it, because I do think it takes a whole village, right, to really get there. We need to drive the distribution, which we're not seeing there yet. There is momentum, but we certainly haven't reached that critical mass of distribution effect. And I think together we can do really good stuff. So,
great, thank you. Spencer, wrap us up.
Yeah, biggest misconception. I would say, to say that stablecoins are simply a new form of payment or a new digital currency would be like saying that the internet is a better version of the fax machine, right? We are sitting on, and I agree with my peers here, we are sitting on a massive innovation that is rooted in interoperability and programmability, the likes of which we've not seen, certainly since the advent of Web 1. So it's a thrilling place to be.
Great, thank you. Well, everyone, please join me in thanking the panelists. Really appreciate your thoughts today.
Thank you.